Okay, let's start with the All Country World Index. This is my standard benchmark for the global stock market. So when we look at the All Country World Index, we can chart it. Obviously you can see here, this would be over the last couple of years and really the crash and then the recovery. And you can see that we are almost exactly where we were at the start of the crash, which is remarkable that it has bounced up this much. You know, when we had sort of hit a patch here, I was like, okay, it looks like it won't be a V-shaped recovery. At least in terms of the stock market, it is. Obviously, the US economy and the Canadian economy are still going through a lot of trouble when it comes to unemployment, when it comes to sort of Main Street economic issues. But when it does come to Wall Street, Bay Street, they're looking really good right now. Markets have responded quite well. You can see that we are actually slightly ahead of where we were at the start of the year. So for a lot of investors, to watch your shares tumble about 30%, 33% I think it was down, they've now come pretty much all the way back up, which is just incredible to see that. Other things, I do like taking a quick look at the VIX. The volatility index has continued to drop. So we're now sitting at about 23. Remember, this is a measure of the volatility of the markets. So it was sort of nice and calm for a while. Below 20 is sort of where I like it to be. And then kind of at the start of the year spiked up, fell down, and then whoa, jumped up all the way to 66, meaning the markets were 3 times more volatile than I wanted them to be. This was when things were quite chaotic. And then they really have settled back down. So we're not quite below that 20 threshold that, to me, I've been sort of eyeing for when markets have settled down. But we're so close to it that, if people do want to sell mutual funds or, transfer accounts, things that are going to take several days or even several weeks to process, I am now comfortable going ahead and making those transactions. When the market was really volatile, obviously we didn't want to do that, right? Because if the lag was too long, then you might miss some of those big upticks, which we have been seeing. So, really, but that said, now I would say that things are calm enough that I do feel comfortable making those sort of, laggy transactions. Exchange traded funds, ETFs are great in that the trades go through instantly, so I can sell something and buy something else right away. But when it comes to mutual funds, or if you're looking to switch from one institution to another, it does take time. You are going to be out of the market. So we want to see that low volatility while we are still going to be out of the market. So from there, it is nice to take a look at oil prices. Oil prices have continued to bounce back up ever so slightly. So you can see, obviously, this was when it went negative for that ridiculous day. And then now it's just been very, very cautiously climbing back up. We're now at $42 per barrel for light crude oil. And then here in Canada, the metric we care about is this WCS, this Western Canadian Select. So, at 30 bucks a barrel. So again, this is below break even. A lot of them do need it to be at about 35 or 40 bucks for this WCS to break even. And certainly we have seen a lot of new projects getting canceled if they're going to be more expensive. That said, we're certainly not in the dire straits that we were. And that, this economic recovery, at least in terms of the markets, is proving to be fairly stable. So happy to see that. To me, these are good signs. A little bit worried about, the U.S. election and that, the fact that markets came back just as high as they were. If the U.S. were to shut down or there's a big problem in the U.S. election, would be cautious there. But the fact that we are kind of back to these levels, right, of kind of where we were before the crash, really tells me that, likely if you haven't rebalanced for a little while, now is definitely a good time to rebalance. Like in a dream world, people would have rebalanced right at the top when things were really high at the start of the year. They would have rebalanced right at the bottom, meaning they would have, basically bought more bonds at the top to be a little bit safer or, to have the appropriate risk level. And then as the market crashed, your shares would have fallen, right? But your bonds would have remained stable or even up a little bit. And then from there, you would have sold your bonds to buy stocks at this low level had we rebalanced right at the low. And had you done that, well, now your stocks have bounced back up so much that you're probably at a higher risk level than you should be. As well, if you just like hadn't rebalanced, you're one of these people that like hasn't rebalanced for the last 2 years, well, then again, your stocks are probably up kind of back to where they were at the start of the year. That really now I would say is a good time to rebalance to make sure that you are at that appropriate risk level. So that's really it from my market overview. You know, stock market has really been bouncing up, back up, even though I know there are these massive problems with unemployment and with real estate and, you know, with back to school coming up and cold and flu season. Certainly there are a lot of concerns around COVID, but the stock market doesn't really seem to be pricing those in. The stock market is very much pricing in, I would say, a pretty solid recovery here. So it is what it is. If you've got questions, let me know. Otherwise, that's it for the market overview, and I'm going to move on to stock splits.